But what happens if the market goes down and you need money? You're now withdrawing from a loss. And that actually leads to compounding losses. So if you have an investment, you need to manage risk to lower volatility, lower correlation, get better risk-adjusted rates of return, but also pragmatically, so you don't have to pull out of your growth-driving investments in what the book calls inopportune time. So an example of this kind of paradigm where if you need money at an inopportune time, you need to have safe assets in order to fund those goals. I have a client who wanted to redo her house. She wanted to redo some house project. She needed $90,000 from her portfolio. Well, the problem is she calls me in April when all this Trump stuff is happening and the market's taking a shit. So instead of selling her stocks at a 10% discount, solidifying that she's lost money, we have built into the portfolio in one of the subsections here of bonds a short-term treasury section, which was very, very little affected. So the stock portion looked like this, the bond portion maybe looked like this. So she sells her bonds, and what that allows is for her stocks to rebound in value. If she would have sold her stocks here, she would have had a 10% loss. These shares that made up the $90,000 that she needed then went on to trough to peak appreciate 25%. So she made herself a free 25% by not selling out of her stocks at an inopportune time.